Okay, welcome guys. Today I'm going to explain a little bit more about the basics of a chart. I won't be going in depth on every subject, but I will just take you along with what the basics are if you look at a chart, charts we share, and how you can put that into work eventually. So there's a couple of things I'm going to walk you through. We'll start with candlesticks and volume. We'll talk about the EMAs and MAs, so the exponential moving average and the moving average. A little bit more about support and resistance, trend lines, RSI and divergence, and long-short positions, which you can find sometimes on charts, analysis, and how you can enter of that. So yeah, we'll go about that. So also, if you have any questions, feel free to ask. Put those in the chat box. I will look at that once in a while. And if it's a question I can put in the explanatory, I will answer it right away, or else I will answer it after the session. So this is just a basic chart. So we'll start with candlesticks. So what are candlesticks? Candlesticks refer to the stick you see on each chart. Now there are different type of charts, so I won't go through all of them. I will just for now stick at the chart, the candlestick you most of the time will see on our charts. And what does it tell us? It tells us a couple of things. There are four important things you can see on a candlestick. It's the opening price, the closing price, the highest price and the lowest price. And one candlestick refers to a set period of time. In this case, the time frame is 1 day. So one candlestick represents 1 day or 24 hours of trading. And of course, if you adjust the time frame, the candlestick will also adjust to another time frame. So a candlestick on the 8 hour will tell you the price action in 8 hours. So on the 10 minutes, it will tell you the price action in 10 minutes. So you see it gets a little bit smaller on the 10 minutes than it is on the day or on the weekly, because price has way more time to move in a certain direction. So, like I said, it has an opening price, closing price, low price, and a high price. And that's what you see. So if I zoom in, I'll make it a big one. You can see here the highest wick is always the high price. The lowest wick of a candle represents the low price, lowest price. Then there is an opening price. And the opening price is always, well, it's not always the top, because there are two different candles, like you see, a green and a red. The green candle tells you that the closing price was above the opening price, and the red candle tells you the closing price was below the opening price. So if a candle is red, the opening price will be the top line. So like in this one, the red one, you can see the opening price being here. And the closing price is the lower horizontal little line. So it's forming a block. So this is the close price. So we have a high, we have an open, we have a close, and we have a low price. In this case, it was a red candle, so the close price is always under the open price. And in this case, if you look at the green candle to the next to it, you'll see that the opening price was below the closing price. So that means that price in this day started, in this case, at around 25,700, and at the end of the day it was 27,200. So the form of a candle also can tell you lots of things. I won't go into depth on candlestick shapes or candlestick patterns, but the wick below and above can tell you something about sell pressure or buy pressure. For example, you see here this candle is also referred to as a doji candle, graveyard doji, which says that there was a move up during the day because the opening price was here at 29,200. Price moved up all the way to almost 30,000, but at the end of the day we went back down to the opening price. So this means there was a lot of sell pressure, and usually this candlestick is referred to as a bearish candle. In this case, you see it dropped further below the day after. So yeah, that's just the basics of a candlestick. Won't go further into depth about what I said, like the patterns. So I will move on. Next is volume. This is a very basic chart. So if you see here on TradingView, you can add the volume. And also volume tells you exactly what the name says. It tells you the volume of the trading there has been on a certain time frame. So again, if this is on the daily, one candle of volume is the volume representing the daily. Then there's two colors also, green and red. What tells you? The green tells you there has been more buying and less selling. And if it's red, it tells you there was more sold than bought. And also, if you look at higher time frames, you'll see that volume spiked here, and you seen an up move, and then volume is kind of low. But if you zoom in, it spiked again here in the uptrend. So usually volume is used to confirm like breakouts of trend lines. I will talk about trend lines a little later, but volume can be used to confirm if buy pressure or an up move is real. So what you want to see, if an asset, in this case Bitcoin, if it moves up, you want to see the volume also moving up. Best case, the volume needs to be more. The best case is way more than it has to been was before, because sorry, that means there's new money flowing in, which would indicate that the move is legit. All right, that was candlesticks and volume. I will move on now to the MA, SMA, and the EMA. These are the exponential moving average and the simple moving average. First, I'm going to add a moving average. So for anyone who's on TradingView too, you can choose indicators and look for MA. You see here moving average. What it does, it draws a line. So what does this line tell us? moving average is nothing more than a how do you say it? The price of the last couple of candles. So what else? Let's see. Inputs length, make it 50. So moving average, like it said, is calculating the average price of the last. In this case, if you choose the 50 moving average, it calculates the average price of the last 50 candles. So what does this tell us, and how can you use it? Moving average are mostly used to find support and resistance area, and what I'm adding to is another moving average. Most of the times you'll see the 200, the 50, the 100, the 200, and the 21 that are used most. I think that's also a personal thing. But like I say, like for me personal, I like to use for lower time frames, I use most of the times the 50 and the 100. On higher time frames, I use the 50 and the 200. So there's a moving average and there's an exponential moving average. So it tells you they are slightly different. So if I'm now having the moving average 50, I'll give that another color so it's distinguished better. All right, the red one is the 50 moving average and the blue one is the 200 moving average. I will also put in the exponential moving average. And what you will see is that the 50 red one, I'll make that gray, make that red one a little thicker, and the blue one is the 200 EMA, and I will thicken that too. So as you can see, moving average is different than the exponential moving average. It's the case because the exponential moving average puts more weight on the last candle. Moving averages are used to spot a trend. So if you see here, the 50 moving average EMA crosses the blue one. It's called a golden cross on the 50 and the 200, which usually is a bullish sign. And you see here, after that, we had a breakdown, but we had a move up. So also, as you can see, a lot of times, in this case, the 200 exponential moving average is kind of support. So around here, acts as support. So on charts, the moving averages can tell us that there will be a point where price is rejected or where price bounces. So like you see on these 3 points. Moving average alone, like any indicator, is never enough to enter a trade. So you could say, oh, well, maybe price will come back down to this 50 EMA on the daily. So yeah, let's long there because, like you see here, it can bounce. Yeah, but then you also would have to look at like the next, what I'm going to tell you, something about like support and resistance. So let me leave the 50 and the 200 EMA on the chart. We'll remove the moving average. I will move on a little to support and resistance. The question is, does the EMA work on every time scale? Yes, it does, but the lower the time frame and the lower the EMA, the more unreliable it is. So what you want is the higher, you want to work with the higher EMAs. So let's see if I go to the 15 minutes. It's reliable for scalping, but like always, the lower the time frame, the more unreliable any indicator is, because ideally you want a lot of data to be to calculate any indicator. So every indicator you see on the chart has some math behind it, has some formula behind it to calculate why there is the 200 EMA here and why the 50 EMA is here. But as you also can see on the 15-minute time frame, you see here this whole block that it used the 200 EMA to bounce off. But as most of you know, my strategy I use on the 15-minute, let's say there was a trend line here. This is not a good trend line, but you could say, oh, it broke down the 200 AMA. So this could be a good spot to short, because broke down the trend line, broke down the EMA, did a retest. But as you can see in this case, it would have failed because this could indicate a short. But as you can see, it didn't go through as planned if you put out that breakthrough of the trend line. So it's still probability on every time you put on trade or looking for a setup. But yeah, EMAs or MAs can work on every time frame. I personally only use EMAs. I don't know why. Just think that that's what I started with and never changed back to moving average. Plus I like, I think they are reliable and fit my strategy. So I think it's, if you're starting trading, or if you're finding out or looking for what fits you best, I think there is not one better over the other. The downside to EMAs is that it will respond to price movement faster. So because it gives more weight to this, like this uptrend here. If you see this trend here, it will give more weight to that than the moving average. So the moving average would be less, going up less. So I think you have to find out what fits your strategy best. Use them both. Look, like I always say, just go back in replay mode and look for setups and replay that. And one time use the EMA and the next time use the MA, and look what the consequences are, or look what the outcomes is on that. All right, that's for now I think enough for EMAs and MAs, or SMAs are they sometimes called, simple moving averages. So let's go forward and talk about support and resistance. Something you hear us talk about a lot, because we like to look for support and resistance areas. So what is support and what is resistance? Support refers to an area or a price that can act as support, so where price goes and it doesn't fall through, because it's like a barrier for that price. And resistance is the other way around, so that you find that more you find that above the price, an area where the price went but didn't go through and now acts as resistance. So how do you find support and resistance on charts? If you zoom out on a chart, you'll find areas, and you have to look for areas or wicks to places where price has been before, or where price has been a lot and didn't go through. So let's see here. This is a bit zoomed out. I will zoom out. Makes it easier to look at. So most of the time, a local low or local high will act as support or resistance, or even can be drawn out as an area where price could possibly reject, or for a low could possibly bounce, so act as support. This would be resistance. This could be support. Most of the times you want to look for more points of price bounced off, of moved off from. So if you, again, the bigger the view, the better. So as you can see here, I draw this support. You can make that longer, and then you can see that there is an area where price bounced off a couple of times. Maybe even if we go further down back. No. So let's take this as example. Like I said, support. This acts as support. And why does it? Because it acted as resistance in the past. So this area is an area where price has been multiple times. So after this dump that you see here, price went back up, but it went only back up to here. So there were a lot of sell orders at this point. The price went back down, and then it came up again and tested it again. So you see here 2 points where this area acted as resistance. Then finally came back up again, third tap, and there it broke through because there was buy pressure, or the sells that were here before were gone, because the more it taps, the less the sells get. So you see it breaking through here, and now the last couple of days it went back down, and it was a support and resistance flip. That's how you call that. Former resistance, this area turned in support. You see, came here with the 200 EMA, and also this former resistance area, which now turned in support. So this was also, I think the CB call for the 25,300 long on Bitcoin. Well, it was a perfect entry that. So as you can see, based on support and resistance. So on every time frame, on every chart, you can look for support and resistance. I usually have to zoom out for that, but also on lower time frames, can look for support and resistance areas. But like I always say, the lower the time frame, the less reliable the indicators are. You can, of course, trade support and resistance also on lower time frames, but always be more cautious. That's why on lower time frames, you usually use them for scalping. So quick in, quick out. That's what basically it scalping means. So Lower time frames, lower time you're in a trade. Higher time frames, trade can play out a lot longer. So let's say, for instance, price would break through here, would make a retest and go on further. This will take a week or two to play out. Like you say, this candle is just one day, so every candle you have to wait for. So like you see here below, Sunday the 16th, so we'll say the date. So the higher the time frame, the higher or the longer you have to wait sometimes for a play out, for a trade to play out. Going on support and resistance, there's also trend lines. And trend lines, what they say is what they mean. A line that forms a trend. So to make it easy, I'll remove everything I drew. Trend lines are most of the times diagonal lines on a chart with multiple points of you say points of impact, of touches of that line. So I can draw one here, but also see one here. Also, the more you do this, the more you chart, the sooner or the easier it'll get to see trend lines. Well, some people will say 2 times. There's a question in the chat: how many times does it have to touch to be classed as a support or resistance line? So that's back to the support and resistance. Just seen you. Or is this about trend lines? Well, support or resistance. No, not trend line. Okay. Support or resistance can also, you can have resistance if you see, like I said earlier. Let's put this away for a bit. This could be a resistance line because you see price went up there and rejected. So you don't always have to have 2 points. So like Harsh's SFP and his sweeps, like he is using, you could say, okay, maybe we'll get a sweep here. That's based on one point of resistance, and then the SFP, the swing failure pattern, going above and closing below. So that's also based on support or resistance, rejection of price. But usually, to be reliable, make sure it has multiple, well, not per se touches, but areas. Support and resistance is never, I draw lines, but let's say support and resistance is never a line. So just look for areas and know that if it breaks through that area, there's a big chance you will move up like this. You have here 2 touches below. I would say this is the resistance area. Try to move above here, a deviation. You can probably draw it further back, and you see it touched here multiple times. So the further you can draw that box back, and the more price movement or wicks it has, the better it is. Yeah, it's more of an area than a fine line if we're talking about support and resistance. Yeah. You're welcome. Okay, now let's go back to the trend line. Like I said, the more you trade, the more you chart, the easier it becomes to see trend lines before you even draw them. I drew this one too here. So, yeah, for trend lines, also going forward on that question about how many times does it have to touch, I think there are different opinions about 2 or 3 times. I usually want a trend line to have a minimum of 3 touches, because you could draw a line between any 2 points on the chart. So if you would say a trend line has to only have 2 touches, yeah, that would make every how do you say it, every point on a chart to another point is a trend line. So I would always suggest that you look for a point or a 3-point 3-tap pattern, so for a minimum. And what it does, a trend line acts as support also. Yeah, also that's also a thing. Wicks or body is a question. I always use wicks. Well, yeah. But that's also a personal thing. There are a lot of people who draw lines from bodies, but don't mix them. So if you choose to draw from bodies, that's okay, but then draw from body to body. Like here, you try to draw from wick to wick, and it's not that how do you say it, that bad if it goes a little below, but I like this trend line more because, as you can see, it really touches the trend line and then rejects. And you can also draw this from body to body. You still see that it touches also some wicks. But if you ask me on how I draw trend lines, I always I like my charts clean. I think I always use the wicks. Yeah, it's you can, but also there's a question: you can enter the trade after the confirmation of the third line tap. Yes, you can, but with confirmation of other indicators. Never enter a trade based off solely a trend line. So you would have, and that's why I do breakout or breakdown trading. Like for example, at this point, I wouldn't be entering along. Let's have a replay to this point. Let's say I would be looking at the chart like this, draw a trend line here, seeing the 200 EMA here. I would have looked for a breakdown, retest, and continuation down. Yeah, as I don't want to go into depth about trading strategies now, but yeah, you have to put indicators together that work for your strategy. But we'll go into depth maybe later, or maybe another session on how to find your own trading style. So back to trend line. What does a trend line tell you? It tells you, or you draw a trend line to see a certain trend. Replay over. And as you can see, I'll make it simple, this most recent trend line. So what it also can tell you is that if you draw a trend line, there it might be a point where price, in this case, rejects. Because as you can see here, we have 1, 2, 3, 4 times a tap. This also means that resistance will become less. So there's a possibility next time it comes to this trend line, well, you just have to watch if it can break through or that it rejects again. And that's also how you will find patterns on charts. So if I go to a lower time frame, remove this one. You look at this pattern. It's the 4-hour. Not the most clean trend line, but it's just for information purposes for you guys. So trend lines or patterns can tell you the range the price is moving in. So it's always hindsight, and it's not always says it's going to be that. But if I replay it to here, so let's say you were looking at this chart, you'd see a trend line here, not as clean as you would want. 1, 2, 3 taps. So you could say, okay, there will be some resistance here or some support here, because you see it moved under here but then got back up. So if you follow through on this, you'll see that it did actually eventually went back down here and then went back up and rejected that same trend line. So it can help you identify support and resistance areas as confluence or confirmation. So like I said, if you use trend lines with support and resistance, you could find areas of interest. So what a trend line does, it tells you a certain trend line. There are different patterns. You can see there is I have a sheet, cheat sheet, pattern cheat sheet that I already think maybe it's in the classroom too. You can see the different patterns that are used to identify certain trends. So have a look at that too if you want to know more about patterns and trading patterns, etc. So then we also have RSI and divergence. We'll move this again. RSI is the relative strength index, and you'll see that being used a lot, but mostly for the divergence side of things. So how do you get that on your chart? Indicators, you search RSI, and you see here the relative strength index. As you can see, it is a line. And what does this line tell you? It's a momentum indicator. So it tells you, is the trend up? Is the trend down? Is a certain asset overbought or is it oversold? Also, with every indicator, like I always tell you guys, it's not tradable on its own. It's only used for confirmation or confluence of certain trade ideas or trends. So if we look on the daily, gives us a little bit better. Make it a little bit bigger. So, all right. So if you look at the RSI, you'll see a band here between 30 and 70. And if you just look at that, it says if it's moving between 30 and 70, it's moving sideways. And if it's above 70, it means it's overbought, and it could give you a trend reversal. And if it's under 30, it means it's oversold, and could also it could also signal a trend reversal. It doesn't always mean that, because like when we're in a trending market, like when we're in the bull market, Bitcoin could stay overbought for a while because we're moving up. So most of the times RSI is used for divergences, and divergence means that the price, the tops, the lows or the highs of the price move in the other direction than the lows and the highs on the RSI. And what does that tell you? Let's see if we can find a quick divergence somewhere. This one, yes. Let's zoom out a bit. As you can see here, we have a first top, we have a low, and we have a high. So high, low, high, and we have here a high, low, high. But there's a difference between these two. As you can see, the high here is above 70, so could say it's overbought, which could indicate a down move. Well, it did in this case. But as you can see, it made a low here, and then it went back up again and made a higher high. So let's say text. So this is a high. And then price made a higher high here. And as you can see on the RSI, it made also a high, but then made a lower high while the price was making a higher high. So what it meant was that there were less people buying, but price was still rising. So that means that people that are willing to buy are getting less, which could indicate further downside. So what we are looking for, usually if we use RSI, then we want to see a divergence. So in this case, from high to lower high, and on the chart from high to higher high. And if you have to remember, if that line is from high to high on the chart and from high to high on the RSI, it means it's a bearish divergence. So that could signal a down move or further downside, which it did in this case. And then I have to have a quick look to see if I spot bullish divergence somewhere. Yes. This case again, we have a low, low, not a very clear one, but it is one. Hello. I'm not very good at drawing nice rounds here. So again, this is a bullish divergence. We have a low, and a lower low, and on the RSI you see a low and a higher low, which could mean price is bottoming out and we are ready for a trend reversal. Divergence is always used in as an added confirmation of a certain trade idea. So yeah, that's what I wanted to tell about RSI. After this session, you don't have to already know how to draw divergences yourself. This is really just first, well, get to know the chart and get to know what you can see, etc. So don't be worried if you're still not familiar with everything I say. We're gonna have sessions every week. From now on, we'll do around certain topics. So if you say, well, I like to know more about how to draw divergences, I can make a presentation about that, or I can do a Q&A about that. Got lots of time, so everything to get you to the level we are at. So as last, there was a question in the chat the other day or last week about can you tell me something or tell us something about how to read the long positions or the trade ideas if you guys put out analysis or charts without being a proper signal or an official signal. So what you usually see, I will keep it clean and simple, is either a long position or a short position on the chart, and it will look like this. It will look something like this, and of course there will be something drawn, but okay, well, for the view, let's draw this trend line, and let's say we're saying, okay, you have to, this is the trade idea, so we'll draw something like this, and we say, okay, this is our trade idea you can do. What you have to go off, so if you want to know, because this is usually the way analysis get shared, if there is a possibility of a trade idea, then there are a couple of things you have to look at. You have, let's do it like this. This one here in the red. This one here in the yellow. And this one in the green. Those are the three numbers you have to watch. Because if it's a long position like this, then this, the green one, and that's always the case, the green one is your take profit. This is your entry price. And the red one would be your stop loss. So it's actually very simple in this case. Red stop loss, yellow entry price, green take profit price. You then can use the calculator to try or to calculate your risk and how much margin you have to put on the trade. goes the same for a short position, but then you'll see that the stop loss price is always above the entry price. So if stop loss is above the entry price, then it's a short trade. If stop loss is below entry price, then it's a long trade. We're banking on the price to go up. So yeah, that was a little explanation of how you can look at charts we're putting out and what are the most important things to look at. Okay, there are still 2 questions. What would you say is the best time frame for a beginner to trade with? Yeah, I think that also depends. I think a higher time frame is better because that's more reliable. So, and it also teaches you to be patient. Because if I'm honest, scalping lower time frames is definitely something you shouldn't be doing as a beginner. You definitely should focus on getting your strategy together and getting to see it work out on the higher time frames. Because scalping is really about getting in and out of trades. So as I'm looking back, I started on the 1 hour, 4 hour time frames. But you have to be patient sometimes. You have to sit back, watch trades play out, put trades on in the morning, take an hour to watch the charts, draw your trade ideas on the chart, and let's just watch if it plays out during the day. Just make sure that feeling that you have to be in a trade, that feeling that you want to see your P&L, it's something that something that could take over and could give you the idea that you always have to be in a trade and that you always have to trade lower time frames. But I think there are a lot of traders, day traders, that don't watch the charts all day. They just put on their trade ideas for the day and let it play out and go on with their day. So if you want my advice, I'd say just begin with higher time frames and let your ideas play out on those. Warren is asking if you haven't put the long or short position indicator on and it's just a chart with an idea, how do you work out what price your stop loss should be at? Yeah, you always want to be your stop loss at a point where your trade is invalidated. Actually, you want your stop loss to be at a point that you still have time to get out your trade if it's invalidated. So, for example, I'll take this one, get this out of the way, just the chart, just to give you an idea. I'm going to take this one as example because we had an uptrend here. Let's draw a path. We had a bullish move up here and then we retested here, retest. This looks or is a bullish falling wedge. So you would say if it keeps the pattern as respected, it would possibly break out here, retest the trend line, and then continue further. Not saying this is going to happen, but as I'm looking at the daily at this point, we're forming a bullish falling wedge after this move up. So you can see here that we rejected or we used the 200 EMA as support. So in this case, I would be looking at a break out of the trend line, retest, continuation up. What I usually then do is put my long position here. I want to know where I am going to enter. If we break out here, I will be entering at the trend line. And then in case of a stop loss, it's just a case of, okay, where do I think that my idea is invalidated? So if my idea is I'm trading a breakout of a bullish falling wedge, when is that idea invalidated? That idea is invalidated if we break down again into the bullish falling wedge with a confirmation. So confirmation up means one candle close above and a retest, and then I would enter. So if it then would close below, have a second candle below, I would go out. And in this case, as you can see, the 200 EMAs, which doesn't fluctuate or moves up or down very quickly, the 200 EMA will also still be here. So in case we do get a rigorous dump, I want to be my stop loss below that lower trend line, because in that case I have built in some securities to not to always have the time to close a trade before it hits stop loss, because stop loss is a how do you say it, stop loss, you want your stop loss to not hit only in case of emergency. So if we see a huge dump in the market, then you want your stop loss. But if that doesn't is the case, you want invalidation to be at some point, so you can say, okay, I gave my trade idea the room to move, but my trade idea is invalidated and I'm still not at stop loss, so I'm closing for 0.5 R, like you see us tell sometimes. This is always, stop loss is always 1 R. You always want to be trading 2 R plus, never less, because then the risk reward ratio just doesn't add up. So yeah, this is just an example, Warren. It's not always as easy as it's not always easy. I think it's not always the same point where you put your stop loss. Just look for invalidation and look for the ultimate place. You would say my trade idea isn't valid anymore if you're looking for where you want to put your stop loss. So then for a recap, we had the chart explained the basics. We talked about candlesticks and volume, EMA support and resistance, trend lines, RSI and divergence, long short positions. Want to thank you guys for showing up, for your questions. Hope you find this helpful, and I'm looking forward to our next session, guys. Have a great day, and we'll talk again soon, guys.